What we're going to do, the first sort of 50%, two-thirds of the program, we're going to talk about PACE in the U.S. and some of the issues encountered there, and then David will fill out the end with where bringing PACE to Europe is today. So with that, Nicole and Stacy, if you want to maybe talk a bit about the Resi PACE market in the U.S.
I can go ahead and start. And,
actually, do you have the poll questions? Okay. Okay, potential investor. All right.
Well, that's good to see.
Yeah.
As an issuer.
I think there were 3 questions. Can you go the next? No? Okay.
One responded to both questions.
Oh, okay. All right. Well, anyway, Stacy, Nicole, why don't you start?
I'll start, and then Nicole, you can jump in. So I'm not sure how many of you are familiar with PACE, so maybe I'll start at the highest level, just related to the nature of the asset class and the benefits. So PACE is a form of tax financing to finance renewable energy and energy efficiency improvements on both residential and commercial property. Patrick asked us to start off on the residential market, and the benefits there to property owners are essentially long-term fixed-rate financing that is not debt. So it doesn't go against their borrowing capacity or their credit. It doesn't require a FICO or other credit analysis. There's other underwriting criteria that are relevant to asset-based lending. And there are tax deductibility benefits, as well as the potential for transferability upon sale of the home. So a tax assessment is placed on the home. The financing is paid back through the property tax bill. And if the property owner sells their home in the future, that obligation carries with the property. The benefits and maybe I should back up and say that typically PACE is implemented in partnership with a governmental authority. So either a city or a county or a municipal region, a state, a country can create underlying statute to enable PACE and thereby allow for the property assessment to be placed on the tax rolls and the property tax collections to be collected through that municipal agency. The benefits of a city or county putting this in place are driving private capital to support renewable energy and energy efficiency upgrades. Along with that, CO2 and greenhouse gas emission reductions, job creation in the local area, as well as economic stimulus for that community, all at no cost to the government. And for investors like yourselves, the benefits are that as a tax-based financing, this is a senior lien asset. It sits ahead of the mortgage or any other debt on the property. It's property secured. It cannot be extinguished through any means except any means, even bankruptcy. And the repayment rates are traditionally near perfect. For instance, we have at this point, I can speak only to the Y-Green portfolio, about a 40 bips delinquency rate, and we've had 0 foreclosures since the beginning of the program. I believe the PACE industry at large has had not a single foreclosure in the 9 years that it's been in existence in the US. So a very, very high quality asset with a very high quality repayment stream. In terms of the activity in the US market, by the end of 2017, it's anticipated it'll be about a $4 billion volume of originations, cumulative over the history of PACE, and active in multiple states: California, Florida, Missouri, and a number of others. There's, in fact, 32 states in the U.S. with PACE-enabling legislation that are in various stages of their program development for PACE. So I don't know, Nicole, if I missed anything you want to add. I'll close with saying that from Y-Green's perspective, we are one of the leading PACE providers in the U.S. We offer both residential and commercial, and we've done to date about $480 million in securitizations of our PACE assets. We were the first issuer to achieve a AAA rating, and we were just voted by Global Capital as the issuer of the Year for 2016 and the ABS Deal of the Year for 16 under the esoteric asset class. So great to be here.
So I think Stacy touched on all of the main points as it relates to residential PACE in the U.S. I will kind of expand upon the securitization market. So in addition to Y-Green, Renovate America has accessed the ABS market through our Hero Shelf. We've issued over $2 billion in bonds to date, and that is spread across 10 deals. So we are the largest issuer in the PACE market as it stands today.
Okay. Stacy, do you want to talk a little bit about how commercial is different, CPACE?
So we, as I mentioned, also do commercial PACE origination. And while the residential volume is will be around $4 billion at the end of this year, the commercial volume is a fair bit less, about $350 million cumulative over the life of the PACE programs in the U.S. It is similar in its value proposition, so low cost, fixed rate, long-term financing for commercial building upgrades. It's off balance sheet, so it, by virtue of being a tax, so has benefits to commercial property owners in that regard. It also has the benefit of being able to pass through many of the costs associated with triple net leases or other types of lease structures, where the property owner can actually pass through the PACE financing recapture to the tenants who are also getting the benefits of the energy savings. So it closes the gap on this kind of split incentive problem that you've seen in the commercial marketplace for energy upgrades. I would say that it's been a little slower to take off in terms of volume, partly just awareness in the marketplace. I think commercial transactions tend to be a little more complicated in the sense that there may be very complex debt structures or complex ownership structures, tend to be a little bit more detailed in terms of, or tricky in terms of the underwriting. So the overall volume is low, but we see, again, many states, 32 in fact, that have commercial PACE legislation in the U.S. And I think probably, well, there has not been a commercial securitization to date, partly because of the chunkiness and the concentration of commercial PACE assets, that you'll see something, I suspect, coming to market probably sometime later this year, maybe early next, a first commercial PACE securitization.
Do one of you want to also just touch on Senator Cotton's bill, just so we kind of round out the whole?
Sure.
It seems to be dying a slow death, but I don't know.
I can do it if you like. So what Patrick is referring to is that in the U.S. there was a sample bill introduced by Senator Cotton, which would have PACE fall under TILA, Truth in Lending, which is a bit anachronous in that PACE is a tax-based mechanism that is for real property taxation, which in the U.S. rests solely in the hands of the states, whereas Truth in Lending and the CFPB is a federal organization. So the Cotton bill would apply TILA to PACE in ways that would be very onerous, meaning like municipalities might have to register as mortgage brokers. It's something that it doesn't apply right to PACE, it doesn't fit. So the industry has been working with his office to help him understand the nature of PACE, which aspects of TILA could and should apply, and quite frankly, the industry is already voluntarily conforming to in our disclosures, and which parts of Truth in Lending Act, it does not apply. What we're seeing is that the likelihood of that bill getting any traction or moving in the session is very low. So for any of you who've heard about that or been curious as to its impact, it's not likely. He hasn't been receiving additional sponsors to that bill, and just given the priorities of the Congress, we're not seeing that will likely move. So you said dying a slow death. I like your phrase. I'll just say we're not seeing it being highly likely of moving this session.
Okay. Tony, do you want to talk a bit about the rating agency considerations?
Sure, I'd be happy to. Yeah, Kroll Bond Ratings has rated every PACE issuance that has been issued since 2014. And on the panel, we're lucky enough to have Y-Green and Renovate who are major issuers in the space, also Renew Financial being the third. The majority, by far, has been residential, as the panelists have said. I would say that in Stacy's Y-Green deals, there's also some small allowance or bucket for some commercial properties in there as well, which I'd be happy to talk to how we would view it. I tend to agree with them totally about the asset class in general, because it's a very, very strong asset class from a credit characteristics. These are tax liens. They're attached to the properties, and therefore the payment of those are senior to any other debt, including mortgage debt, which also creates a little bit of the tension around the asset class, which I'll talk to. And Stacy was absolutely right. The performance has been extremely strong. The delinquency is relatively low, and with absolutely no foreclosures on the properties or losses incurred. So it's been a very, very good, strong asset class from that point of view. On the negative side, because being a rating agency, we do look at both sides of the equation. There is what we'll call regulatory overhang. There's concerns over the long term, not necessarily the near term, about things not just that was referenced with the Cotton Bill, but being the compliance and with consumer laws and regulations, although that's something we do focus on in our diligence, but also the objections that the FHFA has raised with regard to the Fannie and Freddie mortgages, that they won't buy mortgages that where there's PACE financings attached. So in some of the pools, that has created not losses per se, but higher levels of prepayments. From a credit perspective, it's not a negative necessarily. It just pays out the bond sooner. But certainly that's something where when where a homeowner is selling and then buying a home, it's a consideration that's certainly become more heightened, I would say, over the years. Now, magnifying that risk and the regulatory risk is the tenor of the contracts. Despite the very strong strength of these contracts, they're also very long-term contracts. The PACE contracts typically match the tenor of or the life, I should say, of the project that they're financing. So some go out maybe 15, 20, even 25 years. So there's a very, very long time horizon to consider versus, let's say, a traditional consumer credit, consumer loan or auto loan that runs off relatively quickly. So that's another perspective. When we're approaching PACE as an asset class or as an issuer with the three companies that we've rated programs for, what we do is, and I'll talk a little bit in general, then maybe focus a little bit more on the commercial side, commercial properties. But what we do is we certainly do a diligence with the originator of the assets, so Y-Green and Renovate and Renew, to understand their underwriting guidelines relative to the programs that they're managing and originating for. We will certainly also look to things that were also referenced, that their ability to comply with disclosure, consumer disclosure, although not necessarily a requirement today, something that may come down the path. And as Stacy said, the industry has certainly focused on that as an industry to certainly enhance the disclosure to the consumer. So that's something we certainly look at. Then we also look at the servicer. Now, the reason I separate that, because within each of these programs, and this is one of the credit strengths as well, there's actually a separate third-party servicer administrator to the program. It could be a company like David Tausig Associates or Wildan, who actually work with these programs. And what they're actually doing once the origination takes place is they're the parties that are responsible for getting them onto the tax rolls, and then for servicing them beyond that point. So the involvement of that third party also adds some strength to this asset class. So it's not necessarily the originators that are doing those functions, although I'm sure they do get involved with problems if they were to occur. But it's really this third party that adds strength to that. So that's something we do diligence on as well. Also, because these are municipal, county, state programs, we look at it from a perspective of what risk does that add, if any, to the actual issuance of debt. So at Kroll, we'll have our public finance group get involved as well and look at the counties that are involved. And the issue there would be if there were a bankruptcy of a county, perhaps, what impact would that have? Is there any commingling risk as that county is holding cash for during that tax period, which could be like 6 months or so? So we see what kind of risk that adds into the rating of the deal. Now, development of a loss proxy for what seemingly is a relatively new asset class is a challenge for most asset classes to determine how you're going to develop this. At Kroll, and every rating agencies have different approaches. At Kroll, what we use, and we think it's a very good proxy, is looking at real estate tax defaults. So what we do is we get the information for each county that's in the pools that are being securitized, looking over a horizon of 10 plus years to see how those losses or how those delinquencies really have gone through and what they look like. And then when we tried to break that out by consumer versus residential versus commercial properties. And then what we do is when we're actually stressing the deal into the cash flows, we're putting stress multiples into that, pretty significant multiples given the time frame of these contracts. On the commercial side, in addition to all of the above, I guess, we utilize the resources of our CMBS group to work with us. As Stacy rightfully says, the commercial property pools tend to be lumpier. So when you have lumpiness, it certainly adds more risk to the actual assets as opposed to 6,000 residential contracts that could be securitized. You'll have far less on the commercial side. We look at things like the valuations that are in place because most PACE programs don't always require updated appraisals. So it becomes more of a concern when you have larger properties in the pool. And with those properties, we also look to the environmental risk. And that risk is important to the extent that maybe there'll be certain industries in the pool like gas stations or dry cleaners, things that have a larger risk of environmental contamination and cleanup. Because when we look at these pools, they really should be self-sustaining. So any costs associated with environmental cleanup need to be paid by the actual transaction. So we try to look at that and kind of size that into the transaction with regards to liquidity and to mitigate the risk within the assets. So.
Okay, thanks, Tony. Joe and Mike, do you want to just touch on what investor considerations are that you look at?
Here at Lord, we're responsible for being an investor, but also advising many issuers around investor considerations. So we're looking at many of the key things that have been discussed from Tony's standpoint as well as from the issuer standpoint. And certainly for any issuers in the room, we'd be having conversations with you if you're interested in the asset about how we think about this from our perspective as an investor. So looking at a lot of the key themes that were raised, when we look at these securitizations, we're thinking first and foremost about borrower motivations. Why would someone be taking out a lien like this? Is it to manage debt profile? How do the green benefits impact the property values that they're assessing? How do we view the concept of increasing property values and undertaking increases in property taxes in order to address that? Because we do view the credit profile as extremely strong, but obviously if it increases a burden on a dramatic basis, then we have to worry about the knock-on effects that that's going to end up ultimately having. This isn't a mortgage, and I think that that's obviously a theme that's been raised and is really an important one. So it's not just the impact that it's going to have as an investor in this particular asset, which is very positive, but then the ripple effects, whether they be regulatory, but also from the perspective of the ability to pay, and then how does that affect the ultimate repayment profile of this asset and any follow-on impacts that we might see. When we think of geography, one of the constructs that we've had to get comfortable with has been around geography, because from early stages, personally looking at this market, it's been California. So what's been securitized has been overwhelmingly in the state of California, which as a securitization investor, all of us know, we're used to looking at much broader geographic ranges. Can we get comfortable with that, understanding that you have a very high quality asset class, albeit in a very defined geographical range, versus something, especially with U.S. securitization, where we've looked across 20, 30, 50 states, even in newer types of assets. So it's been looking at the legal construct and how that overlaps with certain types of diversification, and then how variance within structures are going to impact this. Because as Stacy and Nicole said, because this is done on a municipal, county, state basis, when we assess the differences now that these programs are growing across states, are there differences in the state programs that are going to have any impact on investors? And to date, from what we've seen, most are really following model programs. So where there are variants, there's very little change from program to program from a pure credit standpoint. All of these ultimately are getting around to key legal considerations, because as Tony said, that from an investor standpoint, how do we feel around the base legal analysis here? Hearing no foreclosures is great. Ultimately, we have to model and expect that there's going to be some form of foreclosure event. What happens when that does occur? How do we think about the foreclosure process? Are we looking at just an extension risk on the asset, which we've assessed very favorably, but had to spend significant time getting comfortable that that's not going to have either a cliff risk to the investor or something where we have to rely very heavily on those parties and has an element of the unknown to it, which we've all seen with many other asset classes whenever markets reach a state of upheaval. And then last, and it's an important one, is both a positive and something for consideration, is around the asset tenor. There aren't a lot of ABS asset classes that are this long, which is fantastic for all of us that look and try to extend duration. If we think about the ABS market, this market has primarily been, call it a 5-year weighted average life, give or take, or in. And this has been a very positive way for many of us to be able to achieve longer dated duration. But obviously, the offset to that is fixed rate, longer duration brings with it in this environment considerations that many of us frankly haven't thought about, which is the impact of rising rates and holding longer dated bonds. So all of these, in many respects, are resulting in slightly different investor views, not necessarily negative ones, and certainly for many of the investors that have bought the couple $2 billion in paper that's been issued already, I'll say they're a general state of pleased with the performance and the rate value that they're achieving. Certainly very strong risk-adjusted returns that they're seeing, but slightly different views that they have to take compared to many other traditional asset classes. Michael.
Sure. The European view is very similar, but obviously a little bit further behind where the US is. Lord Bencher, we're a closed-ended investment fund of about $1 billion of gross assets, but we're also an issuer. And we've issued some very long-dated debt that has been extremely well received in the pension fund and the insurance company sector in the UK. We also provide advisory services to other investment managers, particularly in the UK pension fund area. And they are all interested in assets of this type. A lot of the criteria we'll be discussing, a lot of the US elements that you can see, the long-dated nature, the very strong collateral, the low default rates, all very, very interesting. The main issue is the legal structure and how it translates across Europe, particularly into the UK. We've had some discussions about the fact that TILA, Truth in Lending, doesn't apply. The equivalent in the UK would be the Consumer Credit Act. It's very difficult to imagine a product like this that wouldn't be governed in some way or other by that. So exactly how that translates is going to be interesting. I'm sure David will move on to a lot of these things when he discusses how it's happening. You know, we can see these products emerging in Germany and Italy in particular at the moment. But essentially, the asset managers who will be buying these products in Europe will be pension funds or insurance companies looking for the securitized version of this product rather than the direct lending elements. That in itself is going to require quite a quantum step in the market in Europe. A typical pension fund we were talking to recently have an allocation of this sort of asset of £1 billion. It's got to be quite a and that's a diversified portfolio they're looking to hold. You've got to imagine quite a jump in this product before we get to that sort of stage.
Okay. David, do you want to talk about PACE coming to Europe?
Yeah, thank you. Should we show the presentation or should I go? Yeah, okay, thank you. Well, it's a pleasure to be here to share this stage with the leaders of the sectors. So I will tell you a little bit about the project of the Genie Finance, which is a company that has the mission to bring the PACE, the US PACE experience to the European market. So we realize that it's quite a challenge, but it's also an incredible opportunity. So, yeah, thank you. Also, which is the bottom? This one?
Green one, the green one.
Okay. The green one. Okay. Okay. So, but very quickly, we believe that the finance has been considered kind of evil in the last 10 years due to what happened in the financial markets. And this is a perception that has to change. Finance is part of the solution if we want to tackle the huge challenges, but also big opportunities that we have in the markets of today. Of course, what I'm going to transfer to you is my view as an entrepreneur. It's not a financial perspective because PACE as of today or on-tax financing as of today is not present in the European market. We are talking about something that is under development. And if we succeed as entrepreneurs and to create the collateral, then there will be financial securities and ABS, green bonds that are based on the Euro PACE. But if we fail, then it might be other 5 and 10 years without assets. And so we launched the Euro PACE initiative, and we think it's a great start to introduce this great instrument in the European market. So how are we going to do it? Well, we already learned from Stacy and Nicole that PACE has been extremely successful in the US market and is growing almost at an exponential rate in the last 4 years. And now is expanding in the last few years in Canada, Australia. It's under development in South Africa, and we believe that is the moment to bring to the European market. What is the framework in Europe? Framework in Europe is quite different from an economical, social, legal, fiscal, administrative point of view from the US, especially from California, which is the benchmark. And so we are very aware of that, and that's why we launched a European initiative that is supported by the program Horizon 2020 to develop this market in Europe and to understand which is the best roadmap to do it. From a policy perspective, here it's clear that there's strong focus on climate change, on energy transition, which is a relevant difference compared to the US market. But also the framework from state to state, of country to country is quite different. There have been some countries being very successful in financing energy efficiency for buildings, and some others are laggards. Then we also need to understand the collateral, the asset that there is beyond these esoteric products, which is, of course, buildings. It is calculated that at least 70% of the buildings that are existing today, they will still be here in 2050. So investing in building retrofits is one of the key drivers of European policies if we want to achieve our target in the next few years. And then the focus on consumers, citizens, and customers, as this is not just about energy efficiency retrofit, but the main driver for them to decide to go for a home retrofit, which is at the base of everything, at the base of purchasing and investing in these retrofit. It is driven by the desire of having a rehabilitation of the house and improvement, by better condition in their house, better health, better comfort, smart and connected homes, recharging station for electrical vehicles. It's not driven by energy efficiency per se. I'm sure that most of you don't even know what is energy efficiency. It's not very sexy asset, but is very important for the future of, I would say, of humanity. So in terms of policy, just a quick focus to understand how this policy beyond this issue in Europe, it's always been top-down. So things are designed and decided in Brussels, and then member states have to find out a way to adopt those policies and to translate in programs. And on the other side, there's been a very strong focus on fighting climate change and energy efficiency, but not always being successful. The interesting data is that there's a strong commitment from the European level to reduce emissions up to 30% by 2030 and up to 95% by 2050. This has massive implication, as you will see, in what investments needs to be done in the next 20 years. So in terms of member states, as I say, there are states that have been very successful in investing in energy efficiency retrofit, like Germany, with the bank KfW, have been invested over 20 billion in the last few years in energy efficiency retrofitting of buildings. Also, France has been quite active in the last few years, investing over 15 billion, and launching the energy transition law and the energy decarbonization law that are going in the right direction. But as I say, there are other countries like Italy, Spain, Poland that are lagging behind from energy in building retrofitting. And so this is an opportunity to launch new instruments that can be a catalyst in the market in order for this transition to happen. Just for you to understand a little bit the stock of real estate, 75% of the total buildings in Europe are private households. And so that is where we are going to put our focus in our initiative, the Europace. Also because, as I said before, we are looking for solutions with a massive impact from a climate change point of view. And the very interesting data that we got from the American experience, which is the one that has inspired us, is that they have been able to achieve exponential growth in the residential market, as Stacey Nicole explained. So as I say, that our first focus and what we are learning from the American experience is it's okay to have top-down policy, but it's very important also to create a bottom-up demand. And so our focus is on consumer, and being able to really put all the elements together. Also very important for us is the convergence of different elements like the digitalization of technology, so energy power, distributed energy power generation, energy efficiency, energy storage, smart home are converting, and these will require massive investments in the next few years. So our approach is creating these 4 pillars that you can read here in order to create an asset that can be standardized and can go for aggregation. And so that it's an asset basically that has the best requirements to become a securitized asset. We are going to include in our project and in our initiative the latest directives and the latest agreements on the STS protocols. As I'm sure you learned about the latest evolution in Europe. It is scheduled that by 2019, the simple, transparent, and protocols, securitized protocols, will be in place, and these could provoke an important increase of investments in this type of assets at European level. So investors can have important benefits that have been explained before, so I will skip on this. And our goal is to be able to launch this program, the Europace program, in 4 cities in at least 3 countries by 2020, to create committed funds of 200 million by the following year, and to reach the 5 billion milestones in 2025, as I said, with an exponential growth. And that is it. Thank you.
Okay. Thanks. Are there any questions? I don't know if we have a mic or how this, maybe you just shout it out. Okay.
How do you imagine enforcing your rights if you should ever have a foreclosure? Do you have to go through the municipality to pursue repayment? Who goes about doing the tough work when there's a default and the property sits there empty? Who goes about that?
I'll repeat it just so everyone can hear. So what's the process of foreclosing on a PACE asset? Who does it? Right.
Or is it the PACE lender?
Right. Stacy, you want to take a shot?
Sure, I can tell you the structure that we've employed in the U.S., and that might be translatable here. So essentially, in order to set up a PACE program, a private administrator like Y-Green or Renovate enters into contract with the governmental authority, which is essentially the enabling body to enable the PACE assessment to be placed. So in fact, when a property owner enters into a PACE contract, the countersignatory is actually the government agency. Now, what happens is, in return for us funding the project, the governmental authority actually assigns the tax collections and the foreclosure rights to the program administrator, who then subassigns that to the investor. So the ABS investor actually receives both the right to receive the collections, the cash flows, as well as the foreclosure rights or the attendant benefits of that instrument. So what happens if there is a foreclosure process, and there has not been one to date, but the way the process is set up is that the tax administrator that Tony mentioned, in our case we use Wildan Financial Services, is a sub-administrator under Y-Green that basically prepares the levy for the tax roll, reconciles the collections received from the tax collector once taxes are paid. If there's any shortcomings, those will be documented as delinquencies to the degree that they're not remedied. If it will go to foreclosure, they have freestanding instructions with foreclosure counsel as to how that process gets implemented. So it's actually under the program administrator. We would affect that through our servicer on behalf of the asset owner.
So there's no potential conflict going forward because it's settled up front?
Correct. So the municipality has already assigned those rights to the administrator and their investors. And so when a foreclosure event happens, there's standing instructions as to how that gets implemented, and that's already been codified in the existing documents.
Yep.
Hi, I'm an investor. I know nothing about PACE before coming today, but quite interested as a sustainable investor in the UK. But how were the securitizations issued? Were they private? So a few questions. Were they a private placement, or was there an ability for any investor to get involved? What kind of spreads were they issued on? And what's the secondary market liquidity like in the stuff? Is there a secondary market liquidity, or is they're non-transferable? So just a few sort of market-based questions I'd be interested to understand.
Yeah, Nicole, do you want to? Do you want to do it, Nicole?
Sure.
Okay.
So they are 144A deals, but they are kind of open. They're broadly announced by the broker-dealers that we have as the book runners, so they are open to investors to play in. On our last deal, I can tell you the AA bonds, we had a par bond that priced at 165, and then we had a premium bond that priced at 200. And there is good secondary market liquidity, so I think probably close to $200 million has traded on the year, or for the past 12 months, in PACE ABS. So that's up substantially. I think in years prior, volumes for secondary market liquidity were less than 50 million, if even 25 million.
Yeah, and I think the deals have been oversubscribed, right, Nicole? Yeah.
Yes.
So.
No, I believe they can be made into Reg S compliant. I'm not positive, but I believe so.
That has a big implication for a lot of non-US based investors. So that struggle to invest in
Maybe, why don't you use the mic?
That would have a big implication for a lot of non-US based investors that struggle to get access to 1448 and any Reg S share classes or Reg S classes of assets. But it was just a point, really, more than anything. But
I can share also on your first question about private versus public. We've done 2 private transactions and 2 144A transactions. So there are opportunities, I think, with some of the issuers, depending on appetite and desired structure. Although I will say that the execution in the 144A deals is getting tighter and tighter and better for the issuer. So I think we're all leaning in that direction. Patrick, I don't know if you have a thought on Reg S.
Yeah, I know some of the issuers have been marketing in Europe, educating investors on the asset type. I don't know if any of the deals to date have been Reg S, but yeah, I think that's the next step. So, any other questions? Or okay.
How many levels of taxability are there? Is it triple tax exempt, or is it what are PACE loans? How many levels of tax exemption do PACE loans qualify for?
So these are not tax exempt bonds. They're taxable. Yeah, so there is a potential structure in California that we're looking at that could move. I mean, it would be a slight restructuring of some of the things we're doing. So it maybe is a longer term possibility. But at this point, they're pure revenue bonds. There are tax deductibility benefits to the consumer, right? Because it's property secured, just like the mortgage, they can deduct the interest and obviously, depending on their tax appetite, have to get guidance from their tax advisor as to what's possible there. But on the investor side, they're not tax exempt.
Yeah, it's the consumer I was really addressing, because it seems like that will drive the size of the market, right?
For the consumer, the benefits really that are driving them are, in some cases, access to capital because they have equity in their home, where they may not have access to other types of low-cost credit. So when we see in the market those alternatives that would be there prior to PACE, they were things like vendor financing in the mid-teens, unsecured credits, which could range up, into high interest rate realms, even home improvement credit cards in the 20s. So PACE provides a single-digit, very affordable interest rate spectrum that also brings with it the tax deductibility advantages. So on a tax-affected basis, they're in the mid to lower single digits. And the transferability benefits, to the degree that they sell their home, they may actually be able to transfer that obligation to the new home buyer along with the property. So many sort of attendant benefits around PACE as well.
So screen is saying get off the stage, so I just want to thank the panel. Great job, guys.